What do you get when you cross crypto with real estate investing and syndication? Well, today's Brainiac guest says it's a proven path from $2 billion to $20 billion with the potential to go to $20 trillion by 2030. How? By applying high-tech solutions to age-old investing problems. Is there room for you to play? Well, stay tuned and find out. Welcome to the Main Street Capitalist Show. I'm your host, Russell Gray. I'm here today with a buddy of mine, a guy that I've known for quite a while, and it's an interesting story about how we met, and I'll let him tell that story in a minute. But Mr. Steve Streetman is a really interesting fellow. He's involved in real estate. He's involved in crypto. He's got a background as some type of a brainiac cryptography engineer, technology guy. So I'll let him tell you all about himself. But Steve, welcome to the show.
Well, thanks, Russ. It's great to be here.
So tell the story about how we met. I think it's fascinating.
So I wrote a book called Cryptocurrency and Real Estate, and I published it in 2021. And part of my inspiration was really the real estate guys, you and Robert. I learned a lot from your podcasts over the years. And I have had maybe in the back of my mind the idea of being able to get on your podcast. And so I contacted your organization and got a mailing address, and I sent both of you copies of my book, autographed to you and to Robert. And so a month, 2 months goes by, something like that. And I understand that you took the book with you on a flight to Jacksonville. You read the whole book.
I did.
And then you got me on a phone call the next Wednesday. And I have to say, I was absolutely astonished because you held up your copy of the book, and there must have been 20, 30 sticky flags sticking out of it. And you showed me where you'd highlighted and underlined. And oh my, you didn't just read the book, you devoured it, which as an author, I really appreciate. And so 2 weeks later, I was on the Real Estate Guys podcast talking about cryptocurrency and real estate and some of the synergies there. And 2 weeks after that, I was faculty at Secrets of Successful Syndication. And then you asked me to be faculty on the summit, and we really haven't looked back since then. But what's gotten interesting, besides the whole cryptocurrency and real estate, which was really the reason for getting together, you also found out that I did real estate exchange. And so as one more service I provide at several of your meetings and at the summits, I've been running a cowboy auction, personal property exchange, which has become a very popular feature of the summits. And so now I'm known as the cowboy auction guy, maybe even more than the cryptocurrency guy.
Yeah, it's such a great story. And, it's so funny for the folks that are watching this that don't know, for 20 years, I was a co-host of the Real Estate Guys radio show. And I left that a couple of years ago to start Main Street Capitalist, Main Street Media Network, Christian Capitalist Show, and this whole ecosystem that I'm building. And, I'm still partners with Robert Helms, along with Jason Hartman, Ken McElroy, and George Gammon in the Collective Inner Circle Mastermind. And you're one of our members. And so that's exciting. So we continue to have a relationship, me with Robert, you with me and Robert, and obviously me with you. And, I could see the writing on the wall with respect to crypto. But the other part of it was just understanding, as I study economics, where the system is going and the potential that the system could fall apart. And so Robert and I, many years ago, learned about the Cowboy Exchange through our mutual friend, Robert Kiyosaki, and a guy that he worked with that was active in the exchange community. And when we saw it, we saw that how important it was to learn how to think outside the dollar and begin to do business. And it's really about bartering. And I don't think we'll get into the weeds of it because it's a little esoteric. But if you ever get a chance to do it, it's really, really fun. I know you've been doing it at the Rebel Capitalist Limitless. You've been doing it at the Limitless Expo. Are you going to be doing that again this summer?
Ken and I are talking about it. I think he's interested in having me come back and do a cowboy. He calls it Limitless Exchange. And of course, on the summit at sea, I'll probably be doing that again this year. And they call it Capitalism Without Currency, which was your title for it. And they're all true. They're all good names for it, and they're probably better names than the cowboy auction, which is what the exchanges always call it.
Well, that's kind of where it had its roots. But folks, if you're interested in learning more about this, just send an email to Limitless at mainstreetcapitalist.com, and we'll get you information about the Limitless Expo. I'll be there. Ken McElroy will be there. George Gammon, Kenny McElroy. Obviously, it's his event along with Tarl Yarber. But Steve will probably be there doing this Limitless Exchange, and it's really, really fun. In fact, it's how you ended up getting your membership in Collective Inner Circle Mastermind. So good things can happen to people who show up. The other thing that's really interesting for everybody out there listening, Steve, is that your story about how you came into our world is really my story, because I heard Robert Helms on the radio in Silicon Valley in 2000. And I decided to go to one of his, or 2001, and I decided to go to one of his events. And I approached him afterwards and offered to do some consulting with him. And then I ended up being a speaker at the next event. A couple of years later, I became the co-host of the show. And the rest, as they say, is history. Book, TV show, the summit, the Inner Circle, the Syndication Mentoring Club, all the things that we did together were really, really fun. And I ended up meeting so many wonderful people, and you're certainly on that list. So let's come back to you and let's talk a little bit about where you're at, what you're doing, because I'm going to interrupt you quite a bit. I'm just going to tell you right up front, I do that to you because you're so wicked smart. There's this book out there called The Curse of Knowledge. And I talk about this all the time, and it's a marketing book. But the thesis, one of the main takeaways in the book is that when someone has a basis of knowledge that's over the head of the listener, they start the conversation on a premise that the listeners don't even understand and build up from there, and they're lost from day one. So if I ever feel like you do that, I'm going to slow you down and bring it back down. But tell folks a little bit about this big vision project that you're working on, because I know you got your fingers in a few pots, but you got this one thing that you're working on is kind of like your main thing that you're doing, and explain that to us.
Okay, so we call it a tokenization of real-world assets, right? So this is effectively fractional ownership of things like real estate or private equity or funds. And it works a lot like a syndication. So, syndication, you pool investors' money to go after bigger and better property, like an apartment complex or a hotel or a fund or even a larger company. What we're doing is we're essentially putting a new accounting system around the syndication. So instead of receiving, say, a paper certificate saying, I have this membership in an LLC that owns this property, we're going to give you a cryptocurrency token that's created for the property. And this has some real advantages, both for the investors and for the syndicators. So let's suppose that you're someone who was putting the deal together. You're the one who wants to go buy the apartment complex. You're putting the investors together. But you have to be able to pay your investors. And that's okay when you've got 5 investors or 10 investors. But when maybe you have multiple properties and you have 50 investors or 100 investors or a couple hundred investors, the accounting gets really, really challenging. And many people are doing this as a spreadsheet. There are companies out there that will be an investor management portal, but essentially by having this cryptocurrency, having the tokens go to the investors, and having the tokens have essentially a computer program underneath them that helps enforce compliance and helps manage everything, you can make the accounting, the management, the distributions, the communications automated and essentially error-free, because you can figure out the contracts in advance, and then you don't have to make a line item error on a spreadsheet. This is always going to be a correct distribution to each investor. And so that helps the syndicators and sponsors. On the investor side, well, you can actually prove that you own it. You can look at your wallet address, which is a big old long number that more or less acts like an account number for you. You can look at that wallet address and you can see on a public blockchain that wallet address owns those tokens that represent ownership in that apartment building.
Okay, so Steve, I'm going to interrupt you for a minute because I want to make sure, because, there's some people we already lost them. They're gone.
Okay.
And I want to make sure that folks stay tuned and really listen and understand, because these things don't just get invented because guys like you have nothing to do.
Right.
These things are designed to solve some problems that are out in the marketplace. And so you've mentioned some things some people may not be familiar with. So syndication, I've been teaching syndication for a long, long time. And it's basically just raising private equity. So instead of just going and buying an apartment building with all your own money, if you don't have enough money, you go get a bunch of people who do have money and you set up a business where they are limited investors and they put their money in, and then you are the general partner and you're going to run the deal on behalf of everybody. And you're going to split the profits according to some scheme. And I think a lot of people are familiar with that. The mechanism that holds everybody together is your private placement memorandum, your subscription agreement, and ultimately the operating agreement to the entity, usually an LLC, that's going to hold that. And so when you are selling that to someone, you're selling them the right to put their name on this piece of paper that says that they own it. And then there are liquidity issues and there are accounting issues and tracking issues. And if anything happens to the piece of paper, there's proof issues. And so we've learned that in the world of finance, that as things go online, they become digital. The world of the paper world, whether it's paper banking, paper money, paper contracts, is beginning to move into the digital world. And these tokens, the way I understand it, are kind of a cross between pieces of paper and coins. They're claims on an asset. Is it? Am I right with that so far? I'm just repeating back.
They are claims on the asset, and the real key is that you can move digital things around quickly, efficiently, and reliably. It's harder to move pieces of paper around quickly and efficiently and reliably. And so that's one of the benefits there. And you mentioned liquidity, and that is the other really big change when you go from a syndication to a tokenization.
The idea of liquidity, meaning if I own shares in a limited liability company invested in an apartment building, my money is in and it's staying in until whatever point in time that person decides to sell. Now, in publicly traded securities, if I were to invest, say, in Apple Computer, I'm invested in Apple Computer. The piece of paper that says that I get it is kind of a two-step. I have a brokerage statement that says that my stockbroker owns shares that it owes me. And a lot of people don't know that's how it works, but that's how it works. And those shares are pledged to me in my account, but they're owned by my brokerage on my behalf, demonstrating my ownership in Apple. But what the publicly traded securities offer people is the opportunity to sell those shares and get back to cash really, really fast. That's why the stock market is so volatile. People moving in and out of positions all the time. When you do private equity, it's not that liquid. So you get in and you got to wait. And if you changed your mind or want to get out, you can't do that. But you say tokenization solves that problem. Are these tokens, A, considered securities? B, are they considered like publicly traded securities? Is there a market for them? Where does this liquidity come from?
So that's a really good question. So the answer is yes, they are securities, just like a syndication is a security. It's always been true, even with a private offering, that after a year, typically a year lockup period, sometimes it's a little different, but typically a year lockup period, you are legally allowed to sell your interest, your investment interest. Now, many syndicators also say, okay, they restrict you as well. So many syndicators will also have restrictions on doing it, but that's up to them.
So in the operating agreement, you're volunteering. So it's like when you go get a CD at a bank, you're volunteering to leave your money or obligate your money to be in the bank for a fixed period of time versus an on-demand account where you put money in the bank in the morning, you take it out in the afternoon.
Right. So legally you could do it. And if the syndicator was willing, sort of approval-wise, you could do it. But practically, there was no way to sell your interest. There was no market. There was no place where you could go find a buyer for your interest.
Is that changing now?
It is changing now. And that is one of the benefits of tokenization. It is easy to create an exchange where tokens can be traded. Now, you still have to follow all the restrictions. And so sometimes those exchanges have to be licensed with a particular license in order to trade. And then there are some other exemptions and workarounds that still allow you to comply with the securities regulations.
You being the burden now being on the organizer, the sponsor, the person putting the deal together, not the buyer?
Well, it's actually the burden is on the market maker. So the sponsor doesn't necessarily have to do anything except say, yeah, it's okay if you sell it. The investor doesn't have to create something, but what we're doing, part of our company, is to actually enable those tokens to be listed on what they call a secondary market. The first primary market is when it's first issued. And typically that's restricted to accredited investors, people who are high net worth or sophisticated or have a particular license. But the secondary market, after that lockup period, does not require investors to be accredited. So you can have investors come in. Now you still have to do some checks on the investors, but now you can democratize that ownership so that an average investor who isn't worth $1 million could put $10,000 into a high quality apartment complex. And tokenization enables that. There's still a lot of work to do to make it work, but it's well known how to do that now. And there are companies out there doing it. And what our company is doing is putting all the pieces together.
So Steve, let's do a little bit of compare and contrast again.
Sure.
So because, people, my experience has been when you're trying to explain to something to people that have no frame of reference, they're just like, they're hearing the data and they don't know what to do with it.
Sure.
And so I want to try to compare it to something people understand. So if I'm a person out there and I'm looking at the macroeconomic picture and I'm thinking, hey, you know what? It's a good time to own commercial real estate. Interest rates have gone up. I think a lot of the weak hands have been flushed out. Prices are coming back down. Some of the inflation, the air has come out of the rents. And so if you buy it at the right price in today's market, it's either, got the potential to be pretty stable or maybe even have some upside if we get a little bit of an economic recovery. So if you buy in on that macro thesis, you're like, okay, and you pick your market and blah, blah, blah. Now, if you have a couple of choices right now, 3, you could say, okay, I'm going to put together, my own money and go look for a deal and buy it. And that lets a lot of people out because they don't have the expertise, they don't have the money, and they don't have the time. So they say, well, I'm not going to do that. Second choice would be, okay, I'm going to go find a Main Street syndicator, somebody who does this, and I'm going to vet them and make sure they know what they're doing and look at their track record, listen to their investment thesis. And if I buy in, then I'm going to get their private placement memorandum. I'm going to show them that I'm an accredited investor. I'm going to sign the operating agreement. I'm going to put my money in, and I'm going to just let them execute their business plan and hope it goes well. But the problem is I'm illiquid and I got to write a big check. So the third option would be, hey, I'm going to invest in a REIT. I'm going to find a real estate investment trust, which is like a publicly traded mutual fund kind of investment, where they're placing big money, they're doing big deals, they got a portfolio, and you look at the same thing, you look at the management team, you look at their track record, you look at their investment thesis, you look at their markets, you say, hey, I like all that, and I can write a check for $5,000, $10,000, I can put it in my IRA, do whatever I want. And if I change my mind, sometimes, and I was in a REIT once where I couldn't, but sometimes REITs have restrictions, but in this case, let's say it's I could just redeem, I could say, hey, I go in this week and next week I'll be like, hey, shiny object, I'm going to take my money and go over there. So what I hear you saying is of those 3, this is the most like the REIT experience. Is that right?
So in terms of
just of those 3,
in terms of being able to get in and out, it's like the REIT experience. In terms of the returns that you can get, it's more like the middle experience with the syndicator.
Because it's got less layers.
Yes. So you can invest in a single property, and you can look at a single property, and you can invest in the good property, right? So REITs are often investing hundreds of millions, if not billions of dollars, and they're going to get more average returns as opposed to high quality returns, because you've got a sophisticated syndicator who can do like value adds and improve the property. The people who are looking for those individual syndicators are targeting much higher returns than you get with a REIT. So this allows you to look at returns like from a private syndicator, but with the flexibility of being able to get in and out like a REIT. So it's kind of combining those two into the best of both worlds.
Okay, so this is a new animal then. This isn't just a way of saying, hey, we're going to slap some technology on a business that's been overburdened with paper. I think anybody that's been around the real estate, the mortgage space knows that despite the fact that we're now in 2026 as we're recording and well into the 21st century, you still have industries that are just really, really, really heavily paper-based, and the banking industry tends to be that way, and the financial industry tends to be that way. So I thought when we started this that this was just, hey, here's a more technologically advanced way, more efficient way to do the same thing. But what I hear you saying is, yes, that's true, but it's not the same thing. Here is a more technologically more efficient way to do something that is a hybrid of the best of two different things, and to create something that actually doesn't exist in the marketplace right now, but needs to. Did I rephrase that properly?
Something that doesn't exist in the marketplace right now, but it's also something that's available to more people. So in your example, you're accredited, and you probably have to be an accredited investor to do a property by yourself. If you want to invest with a syndicator, you almost certainly have to be an accredited investor. So what if you're not an accredited investor? Well, your only option is the REIT in the previous piece. But today, if you're not an accredited investor, you still may be able to act almost like an accredited investor and get into some of these individual properties as tokenizations. So it isn't just that it's a sort of a new animal, but it also opens it up to a much broader set of investors.
So you've got three parties involved here that I'm counting. You've got the person who's got the deal, the person who's actually finding the property, managing it, right. The person who's responsible for producing the profit, just like when Warren Buffett, when he was working, I guess he's retired now, he used to go out and purchase a company or stocks in a company. You'd get the person who's actually running the company. So you get that person. So you get the person running the deal. Then you've got the person who's bringing the money, the investor, the people who are listening to the show. This is probably where most of them are going to fit. And then you've got the platform. And then the platform could be like a platform within a platform. So you've kind of got the big platform, but then you've got these other little platforms. That's the part people are going to not understand the most. It's the part I don't understand the most. So just explain that middle piece, this marketplace, this platform, and what that is most like in platforms that already exist that people are going to go, oh yeah, I get it. I know what that is.
Okay. So the platform can be quite complicated. And so I'm going to try not to make it complicated. And I'm trying not to provide any.
I'm always going to stretch you in that way, Steve.
But think of the platform like your brokerage account, where you log into your brokerage account and you can make buys, you can make sells, you can look over the performance of your stocks or bonds, and you probably can even get some of the stock and bond public information that they ship out, right? The pro formas, the latest income statements and things like that. Think of it from an investor's point of view. That's what that looks like. It looks like their stock broker's website. Now, from the deal maker's point of view, the guy who's creating it, it's more like an investor management portal. So they can come in, they can see all the investors in their deal, they can see all the investors who have been qualified but haven't yet invested. They can track any buys and sells, and they can make distributions, and they can run it like an investor portal. So from their perspective, it looks like an investor portal. And there's a lot of machinery that needs to be behind this to make it really work. And that's part of why I've gotten into this as a company, because some of that machinery isn't there yet.
So how robust is this machinery? If this platform is really the kind of the infrastructure, the critical infrastructure to make this market work, where are we at in the evolution? I'm one of those guys, I'll confess, I'm still on Windows 10. You know what I mean? I like whenever a company, a high-tech company introduces anything, I'm one of those guys that just like I wait and see, let the bugs work out. What the difference between a pioneer and a settler is the pioneer has arrows in both the front and the back, and the settler gets to come in after some of that work is done. I tend to be more of a settler. Are there advantages to being an early adopter? Because I know some people are like that. They love cutting edge. They want to be on the bleeding edge of whatever's going on. Sometimes people get rewarded. I remember this mentality that I have cost me a lot of money because I saw Bitcoin, I think, when it was below a penny. And somebody was telling me about it. I could have put $100 on it on a flyer, just said, like, what the heck? I mean, let's give this thing a try. It would be I'd be a 9-figure guy today.
Yes.
And so I didn't do that because I had this wait and look mentality. I wouldn't even risk $100. So that turned out to be a bad decision on my part. So I'm not advocating that people be skeptical, but I do want to understand if you're going to make an investment, if I'm on the deal side and I'm going to bring a deal and put it on the platform and let you tokenize it, and then, where did these investors come from? And if I'm on the investor side, how many deals are in there and how robust is this platform? Can I really count on it? And then if the technology breaks, if that middleman disappears, what do I have to prove that I own anything? And do I end up separating it in some way from the asset? So I'm sure you faced these questions before. So what's the answers to all that?
So think of it as the front end, which is actually issuing it and doing the initial raise of money, just like a syndication. And then think of the back end, which
it was like a crowdfunding type thing.
Well,
kind of like that.
Well, I mean, yeah, it's kind of like a crowdfunding platform, but or just any sort of platform that has real estate deals on it, right?
So it's like an app or a website. I go in, I'm interested, I peruse deals, I go, hey, I'm interested, and I have a way to put my money in, and now I get back out a token.
Robust. The front end is really robust, right?
Okay.
Issuing the tokens is easy. Doing the know your customer, anti-money laundering, accreditation checks, that's all automated. It's easy. Getting the distributions, managing those tokens, that's been in a pretty good shape for maybe 4 or 5 years. But now there's a lot of companies who are coming in and doing that piece of it.
Okay.
So I would describe that as relatively mature technology. And they've even gotten to the point where they have standards for the underlying smart contracts.
Technology years are like dog years.
Yeah.
Right. Now, 1 year is like worth 7 years.
The liquidity side of it, the back end side of it, that's more challenging because there's never been a secondary market for private securities before. And so getting the regulatory certainty that, yeah, this is legal to do, this is legal, this is not legal, understanding exactly what those guidelines are has been a challenge. Right now, we're at a point where that challenge is pretty much solved, but then the connections of the primary market and the secondary market aren't very good. There's a few companies that have both. And then the other piece that's really missing right now, so you know this, any economist looking at a market, you got to have buyers and sellers.
Yeah.
Preferably, you have some sort of market maker as well, somebody who can actually be a buyer when there's no specific buyers for those tokens, because the confidence of being able to sell improves the marketability of the securities.
Right. Liquidity. When people use the stock market as a savings account because it feels like a passbook savings account, just with hyper extreme volatility. And of course, the volatility can work for you. Very little friction. I mean, you can trade a block of stocks for like $8. So it's very, very little friction in terms of doing the transaction. It's a very, very robust, very liquid market. It's the same reason, the Chinese yuan, everybody says the Chinese yuan and Chinese treasury market is not going to overtake the dollar because we have this very deep and liquid, meaning everybody's buying and selling US treasuries constantly. So the principle is the same. I mean, it
is exactly the same.
The idea of there's got to be liquidity if I'm an investor. So how is the industry evolving to deal with that?
So in crypto itself, they create specific liquidity pools where an investor will come in and they'll say, okay, I like Bitcoin and I like USDC, two tokens. And so anybody who wants to trade Bitcoin for USDC or USDC for DC for Bitcoin, I'll be the buyer for either side. And so anybody who wants to sell those, I've got the grease to make that work.
And so what do they get out of this? Condensation on the pipe?
What they'll do is they'll either buy a little bit less than market price and sell at market.
So the bid-ask spread.
Bid-ask spread, essentially, yes.
Okay.
And but when you do lots and lots and lots of transactions, now you're making a little bit of money on a lot of turns.
Yeah, it's what I call condensation on the pipe. Yeah. Okay. So bigger the pipe, the more condensation.
So the mechanisms for doing that are there, but I have not seen anyone set up the liquidity pools for tokenized real estate, for example. It's all the software, all the actual things you need to do it are there, but you need to get the investors, the software, and then the markets all tied together. And I haven't seen anyone finish that yet. That's
okay. So now I've got the lay of the land, and so now I'm starting to smell opportunity, right? So if you're a person who raises capital, I just got done interviewing a guy that's raised $1 billion of Main Street capital. As you know, we've had several people in our world have learned how to go out and raise lots and lots of capital, because I think capital's out there looking for a home. And I think people tend to like real assets, and real estate is like right near the top of the list. And certainly when credit markets do weird things like they did and interest rates get jacked, I mean, sometimes things happen, that's for sure. But when you are on the back end of that, history shows every time that there's a little bit of disruption like there was in 2008 or like there recently was when the Fed raised interest rates very aggressively. On the flip side of that, usually that's a good entry point for a long-term hold. So I think there's people, and Kenny McElroy, our partner in my partner in Collective Inner Circle, is a guy who is very, very active in apartment buildings, and he's in aggressive buy mode right now for this very, very reason. It's one of the reasons I love hanging out with him, because I learned so much about the way he thinks about where we are in the market cycle. Nobody wins by buying at the top when everybody else is confident. You've got to be a thought leader who can really see, okay, this is the entry point. So Kenny's entered. And so I'm bullish on that regard. So let's say that I had the wherewithal to go out and raise, $10 million or $20 million from a group of private investors. Is that a big enough chunk of money that I could step in and become one of these market guys and say, okay, I'm going to put this money in, and I'm going to make sure that if people buy in on these investments and they want to sell their tokens to me, I would buy them because I like the underlying collateral. I would look at it as collateral, the underlying investment. Is that a big enough number? How is the industry going to solve this?
I think it actually is a big enough number. Particularly when the markets are relatively small. So you don't have that many transactions. You don't need that much liquidity. As the market gets bigger, you'll need more liquidity, but then you'll also have more buyers, and you'll also have more investors wanting to come in. So 10 million is probably sufficient to come in as a liquidity buyer. So if you think about this now, we really got 4 different kinds of investor people. You have the sponsor, the person who puts the deal together. You have the accredited investor who comes in on the initial raise. You have the secondary investor who doesn't have to be accredited, who might want to buy tokens that are already there. And then you have the liquidity investor who wants to help make the market.
Make the secondary market happen.
Yeah, exactly.
Make the secondary market happen. Okay, so now I'm making money on the bid-ask spread. And I'm going to guess that if there's not a lot of money in the market yet, the spread is bigger, which means that I'm going to have a chance to make more profit. I'm trying to figure out from a timing perspective, right? Because in the beginning, when there isn't that much money in the pool, then the people who want the money are going to have to give up a little bit more to get it. Later on, when everybody goes, wow, this thing is super cool, there's a lot of activity, now it's going to be, like what happened in the stock brokerage. It used to be, when I was a young man in the stock brokerage, you wanted to execute a trade, it cost you $50 or $100. And that was like $1965, $1970. It cost you a lot of money to broker a trade because you had somebody actually running around on the floor making the trade. With all the electronic trading that came in, now you can trade huge blocks of stock for like, $5, $8 or whatever it was. The last time I don't trade
Right.
stocks, but it's not much. The friction came way down. So the people who are providing that service are making money on volume. So what I hear you saying is that for people who are willing to step in from that to fill that liquidity piece, which sounds like it's the biggest piece missing in that secondary market, if the technology exists, if the accredited investors are willing to buy the tokens, and I know that the people out there who are putting the deals together are looking to get the money. So the
Right.
accrediteds come in, you tokenize the asset, the accrediteds buy the tokens. Now the tokens exist. What you're offering to the token holders is liquidity.
Right.
And that liquidity comes in the form of the secondary market where these investors come in and they provide that liquidity and they're picking up condensation on the pipe. Early adopters have less competition. I'm guessing they have a fatter margin. The service that they're providing for the accredited investors is the assurance or the higher probability that when they go into the deal on the front end, if they decide they want to exit, there's going to be a quicker exit. And of course, that makes more money come in the front end, which makes more money
Right.
available for the people putting the deals together.
Absolutely.
And so this thing is providing a valuable service in forming capital formation to get deals done on Main Street. So did I synthesize all that properly?
Yeah, that's spot on. And there's maybe just a couple of other small pieces that we can add in there as well. Now, what if you want to get access to your capital, but you don't really want to sell your position in the apartment complex? So you have equity. It is a common thing in cryptocurrencies to be able to get a loan.
So is this the DeFi thing?
Well, pretty much all of this is DeFi, decentralized finance. But for this particular case, you could actually lock your tokens into what they call a vault, and you can get a loan secured by the value of your token.
So is it like a token equity line of credit, a TLOC?
Effectively. You can call it that way if you want. And you can ask the question about whether it's advisable to do that. I mean, presumably you might be getting cash flow from an apartment complex. And if you did a loan at a right loan to value, so that the cash flow that you're receiving pays the loan, well, now you have some of your capital back that you can go into another investment with. So there are circumstances when this would be an advantageous thing to do. And there are circumstances when it gives you enough rope to hang yourself.
Yeah. Okay. So those are, I mean, anytime you use debt, whether you're leveraging your home equity to go make an investment or buy an investment property, whether you're leveraging your gold, GLOC, we call it, when you
exactly,
or whether probably the safest equity loan you can take is one against the equity in a cash value insurance policy, because you technically don't have to pay that back and it gets paid off with the death benefit. But that's a whole different discussion. But what I want to really drill down to in understanding this ecosystem that's involved is where the best opportunity is. And usually that's the flip side of where the biggest need is. So in the evolution of the industry where it is right now, as you're looking at it, what's the biggest need? Are there not enough deals seeking to be tokenized? Is there not enough accredited investors seeking to buy the tokens? Or is there not enough market makers in the secondary market? Or are there not enough buyers in the secondary market? Like, those are the kind of the four major components, assuming that the technology is sound and functional, sure, and just waiting for people to discover that this ecosystem exists. Where's the biggest shortfall? Where's the biggest opportunity for someone to come in and solve that problem?
Well, obviously they're synergistic with each other, right? The more deals you have, the more opportunity you have for investors, the more opportunity you have for secondary investors. So it really all starts with deals. And if I were suggesting where's the biggest place, getting more deals in there will revitalize or jumpstart both the investors and the secondary investors and everybody.
Okay,
so I would say really, if you do the deal, everything starts with the deals. If you start
okay, so the marketplace is like a bar, and you've got to stock the shelf with a bunch of alcohol.
Yeah.
Okay. All right. I don't know why I chose that analogy, but I just tried to pick something that everybody would understand. All right. Nobody's going to come into the bar Nobody's going to buy anybody a drink if there's no inventory. So inventory is number one. Okay, so now let's talk to those people out there that are looking at deals, right? So you're out there on Main Street and you're looking at apartment deals, self-storage centers, you're looking at mobile home parks, you're looking at build-to-rent development opportunities, infill projects, residential assisted living. You pick it. Whatever it is that you're looking at doing, and you need to raise capital, and you've got choices. You can go form a traditional syndication with paper contracts and go work your network and raise money the way we've been doing it forever. And that's proven. Or you can find someone like yourself or whoever has these platforms and say, hey, I want you to tokenize this for me. Compare and contrast those two paths. Why would I want to do tokenization over the traditional paper contract way? What do I gain? What do I give up? And where we're at in the condition of the industry today, what risks am I taking that I maybe don't understand compared to if I just do it the way I've always done it?
Sure. So the process for doing a tokenization and the process for doing a syndication are almost the same. It's really, instead of using a spreadsheet, I'm going to use the blockchain to do some of my accounting. And so the tokenization gives you a better accounting system. It just, the blockchain has the defined contracts underneath it. You're in good shape with that. If you're a sophisticated syndicator today, you're already using an investor management platform of some sort, and the blockchain kind of replaces that investor management platform.
Okay, so this is administrative stuff, which is awesome. So I can tell you, having been around a lot of deal guys, those things are the things, like the last things they care about. What they care about is how fast am I going to get funded? How easily are my investors going to understand? If this doesn't work, what's my plan B?
Right. So right now, you're marketing to investors. You're still marketing your deal. You're not marketing tokens. The tokens are just an accounting. Just think of it as an accounting mechanism.
Okay.
And you don't lead with, hey, I'm selling a token and it's got an apartment complex behind it. No, I'm raising money for this incredible apartment complex. So the exact same investors who would invest in you before should still invest with you as a tokenization. And in fact, if you have, say, someone be a custodian for the tokens, just like a stockbroker is a custodian for the stocks, the investors never have to touch cryptocurrency. They never have to think about cryptocurrency. They just get paid the same way they've always gotten paid, except if they really need their money in a year, they may have a way to do it.
Through that secondary market. Okay. So there's a benefit to kind of going through the learning curve and getting out of your comfort zone and doing it the way you've always done it. Now, if I'm the syndicator, because that's who we're talking to the person who's bringing the deal, because you're saying the deal is the number one thing. So I'm bringing the deal in and I go through this tokenization process, and I'm still the one that's responsible for raising the money. So it's not like I'm walking into a platform, this isn't the false promise of the crowdfunding platforms where, hey, put your deal in, all the money will flow in. You still are responsible for raising the money. Can you do a hybrid? I mean, what if somebody says, look, I'm willing to do the deal.
You can do a hybrid. And okay. That was the next thing I was going to bring up is that there are a lot of people who have invested in cryptocurrency and they've made a lot of money, and they're looking at the volatility of something like Bitcoin and thinking, okay, well, I've done really well in Bitcoin. I really don't want to even get rid of my Bitcoins. I think it's going to go to the moon over the next 5 years. But man, I'd really like to have cash flow because I get no cash flow from Bitcoin. I'd really love to have some tax advantages. I'd really love to do all these other things. Those investors are more likely to invest in a tokenization than a syndication. And especially because what you can do with Bitcoin is you can put the Bitcoin in a vault, right? You can lock it up, essentially pledge it as collateral. And it is easy today to get a loan secured by Bitcoin.
So you borrow against a Bitcoin, you buy tokenized real estate, and as long as there's a positive spread, you arbitrage that interest expense. So I borrow against my Bitcoin at 8%. I invest in a cash-on-cash investment like an apartment building at 10%. I pocket 2%. I get the upside equity on the real estate. I get the upside on the Bitcoin.
Exactly.
and I just have to worry about margin call on the Bitcoin and
Yep.
a decrease in rental income on the apartment. So there's a risk, but I
There's a
am able
risk,
to.
and you have to be careful with
I'm
your
able to
LTV in
double dip.
Bitcoin.
Okay, all right.
But
And I
so
don't have
many
to realize
Bitcoin,
any capital gains to move from Bitcoin to get into the real estate.
Exactly. And so many Bitcoin investors have been bitten. In 2017, it went from 1,000 to 20,000, and they sold at 20,000 thinking, or they sold at 20,000 thinking they're really smart, and then now it's
right. They pay tax. They
70,000,
gave
got up
away
to
all the upside,
120,000.
and now they got to
Yeah.
figure out what to do with the cash. Yeah. So this way they get to double dip. Okay. So all of that kind of makes sense to me. As long as they have enough liquidity either in their Bitcoin and in other places in their balance sheet where if the numbers didn't work against them, they could unwind the trade without being
Yes.
ruined. Now,
Which is another benefit of having the liquidity.
100%. So let me take this to another the secondary market with the tokens. Yes.
Yeah.
So now let's say that now I've been able to effectively through this strategy move some of my equity in my balance sheet from Bitcoin over into real estate. Now I can move it. I don't have 1031 exchange though. I can't move money in
So this is a really good question. The way syndications are typically structured, you can't do a 1031 exchange.
right.
So typically you're buying into an LLC.
Okay. So the way I would get a tax advantage that I would really want would be if I put the tokens, if I took the proceeds of the Bitcoin loan and put it into my Roth IRA, and then I use my Roth IRA shares to buy the tokens. Can I do that?
I think so. I'm not an accountant or a security.
Well, we'll talk to Karin about that. So, and we'll get a CPA involved. So this is a financial strategist in me. I'm like, oh, this is a new toy. How can I try to make this work? Well, I don't want to go.
We're looking at ways where we might be able to create the tokens as a tenants in common instead of the typical syndication, because a lot of syndicators will do that. They'll try to break off a piece as tenants in common so that if a person can use 1031 money to come into their syndication and be able to use it.
Have you talked to Scott Saunders about that?
I've not talked with Scott about that. We're working with our tokenization attorney, and we have a lot of questions for him about.
Well, talk to Scott. I had Scott on the show. I don't know, however long ago, but he's like Mr. 1031. He knows all about it, and he doesn't have a dog in the hunt, right? He's obviously a collective inner circle member, so you should talk to him at the next meetup, if not sooner. But definitely talk to Scott. So I would be interested. We are running up at the end of our time together, Steve. So it's been fascinating. First of all, I want to have you back on. I want to continue to follow this because this is amazing. And I think that, what I don't want to do is end up like I did last time where I just kind of didn't pay attention to it because I didn't understand it. And all of a sudden wake up and realize, wow, I missed the opportunity of a lifetime. I'm not saying this is going to be the next Bitcoin, but I do think you have to have more of an open mind than I did when I first heard of Bitcoin. So how can folks follow you? Are you putting content out? Do you have educational resources? What's the best way for people to engage with you and continue to learn?
So the best way to engage with me is really through my LinkedIn page. So I'm Steve Streetman on LinkedIn, and I don't think there's too many Streetmans on there, so you should be good.
Well, I'll make it easy for everybody. If you want to find Steve, send an email to Streetman, just like it sounds, Streetman at mainstreetcapitalist.com. I will send you his LinkedIn page. I will send you a link to buy his book, which I felt was fascinating. And then Steve, just offline, just provide me whatever else you think that people need to have. And then that way they can find you there. But continue. If you had an email or something.
Let me wrap this up by saying that over the past 18 months, we've seen just amazing institutional interest in the real world asset tokenization. Now, some of this is tokenized treasuries, but BlackRock has their BUIDL fund, $2.8 billion. Eric Trump is tokenizing his building in the Maldives, and there's talk about all the Trump facilities going towards a tokenization.
Yeah, I actually went to a very small event where he was one of the speakers. I probably sat 10 feet from him. Security was intense. And I know not everybody's a big fan, but actually up here on my shelf, I have a copy of his book, Under Siege. And he talked about why the Trumps decided to move into crypto. And the big motivation was that when his father got involved in politics and got attacked from all sides, he got debanked. The entire Trump organization got debanked. And they said, we need to be part of some sort of a financial system that isn't politically controlled. And I think that, even more and more people on Main Street, I know the initial impetus behind the Bitcoin crowd was
the people for the Canadian truckers who donated to the Canadian truckers had their bank accounts frozen. I mean, there's a lot of reasons to do that. And not just to have like speculative tokens like Bitcoin or Ethereum, but to have tokens that actually represent assets that will increase in value with inflation, like real estate, like companies' private equity.
Yeah.
So having these tokens aren't just speculative tokens.
So you're saying something I want to make sure everybody understands, folks. So when Steve is saying speculative tokens, you're buying the token with the idea that somebody else will buy it for more later. So you're using it as a vehicle to buy low, sell high. That's speculation. Nothing you can do to control it. There's nothing behind it. When you're you're getting a token of a real asset, that means it's a claim on ownership of something. And that something happens to be a productive asset on Main Street. In this case, we've been talking about an apartment building, for example. And then that way, if that property does better, if the dynamics of what makes real estate investing on Main Street work, if that works, that value that gets created by the efforts of somebody in the real world that you can probably observe and understand. You may not be able to influence, but at least you can understand it. And then that can accrue to you through the token. So that's the difference between making an investment where you actually own something and buying a speculative asset where the only exit is to hope that somebody else will buy it from you for more. And there isn't anything behind it except the claim itself. And there's so much of that going on and people do not know the difference. It's one of the biggest dangers in today's financial market that I see. So I like the fact that you're driving people to the place where they can actually get involved in real assets.
Well, and real assets have gone from about 2 billion, real world assets tokenized, from about 2 billion in 2023 to 20 billion now, a 10x in 3 years, and the projections are 20 trillion by 2030 in another 4 years. So that's 1,000x. So the adoption is really on the right part of the curve right now. And I think we'll be seeing this coming into just commonplace usage over the next few years.
Well, Steve, do me a favor, keep me posted. And definitely, when you've got something exciting to share, call me. I'll get you back on the show. Ladies and gentlemen, if you want more information about Steve, just send an email to Streetman at mainstreetcapitalist.com or look him up on LinkedIn, Steve Streetman. Don't know how many of them there are out there, but you take a good look at his face and you'll know who he is. Steve, thanks so much for being on the show. Really appreciate it.
Thanks for the discussion, Russ. It's always fun to talk with you.
It's been good. All right. We'll have you on next time. Thanks, everybody.